We made this video in order to assist you in beginning your investment adventure. We'll go over the fundamentals of investing, including how to set up your investment accounts and comprehend the various asset types. We'll also provide some pointers and methods for gradually increasing your wealth. To trade stocks, you must choose an account with a broker that fits your trading style, fund your stock account, establish clear financial goals, decide how much you can invest, and assess how much risk you can handle. One effective strategy to increase your money over time is to invest in stocks. You can learn the fundamentals of stock investing with our beginner's tutorial. Let's get you started, regardless of whether you have thousands saved up or can only afford to invest $25 a week. First things first, clearly state your financial goals. You'll stay focused and make better investing selections if you have clear goals. Think on your long and short-term objectives because they will influence your approach to investing. You may have long-term goals like supporting a child's education or ensuring a comfortable retirement, or you may have short-term goals like saving for a house or a trip. Your goals are determined by your aspirations and stage of life. Investors who are closer to retirement usually prioritize capital preservation and income generation, whereas younger investors are more likely to concentrate on growth and long-term asset creation. The better, the more exact you can be. Determine how much you can afford to invest in stocks by taking a frank look at your financial situation. By taking this step, you can make sure that you are investing sensibly and won't jeopardize your stable financial situation. How you approach stock investments depends critically on your investing style. Knowing your style can help you select the appropriate investment tools and approaches, regardless of whether you like a more passive or hands-on approach. Everybody's relationship with money is unique. While some take an active part in their portfolio, going over each and every number in the spreadsheets, others take a more set-it-and-forget-it attitude. They believe that if they merely keep their investments alone, they would increase over time. Even though your decision isn't final, you must start someplace. Your style may change over time. You now know what your objectives are, how much risk you can take, and how involved you want to be in investing. It's time to select the kind of account you want to use now. Everyone has unique qualities, advantages, and disadvantages. Furthermore, the kind of account you select might have a big influence on your overall plan, investing alternatives, and tax situation. To select the ideal investing account for you, you must evaluate various brokers. By this point, you have selected a broker who either best suits your investing needs and tastes or is just the easiest to work with. Additionally, you've made the decision to open a margin account, which allows you to borrow money to buy stocks, or a cash account, which demands that you pay for purchases in full. You will open your account after selecting an account type and brokerage. Choosing the appropriate stocks might be intimidating for novice investors because there are countless possibilities to choose, and you are beginning from nothing. These are some suggestions that are not only the greatest for novices, but also frequently selected by professionals that oversee their own portfolios. These are funds that exchange shares similar to stocks, not stocks per se. These are funds that are managed passively and follow the performance of a certain market index. Look for information regarding yearly fees or minimum balance requirements. A 401(k) retirement plan is frequently provided by American firms as a part of their benefits package. A portion of your income will be set aside for a 401(k) contribution. Depending on the kind of account, this amount may be pre- or post-tax. A pre-tax contribution to a standard 401(k) reduces your taxable income, but when you take money out of the account in retirement, you'll still be responsible for paying taxes. Since Roth 401(k) contributions are taxed up front, you won't have to pay taxes on your funds when you reach retirement age. Up to a predetermined percentage of your salary, your employer may match your contributions. For instance, if you make $50,000 and your employer matches 100% of your first 6% of contributions, they will contribute $3,000 annually, as long as you match at least that much. For the 2023 tax year, an employee may contribute a maximum of $22,500. An account type that provides a greater annual percentage yield, APY, than a regular savings account is a certificate of deposit. You deposit a fixed amount of money for a certain period of time with a CD. You are not permitted to access the funds throughout the account term without incurring penalties. You can take the money out of the CD or put it into a new one when it matures. Consider investing in a mutual fund rather than placing your money in individual funds. A mutual fund is a collection of investments in which you purchase shares, and the manager chooses how the funds are allocated. By doing this, you may diversify your assets and keep your money out of one particular venture. Your money will probably be more heavily invested in equities while you're younger since they carry a larger risk, but also provide a larger long-term profit potential. Bonds, which carry less risk and can help provide a consistent income in retirement, will make up the majority of your investments as you get closer to retirement age. Give this video a thumbs up and forward it to someone you think should watch it if you found it useful. Remember to subscribe to our channel in order to receive more investment advice, guides, and lessons.